Hello and welcome to this episode of Wealthwise. This is the fifth edition, and I have been bringing to you a veteran of the financial services industry, Suresh Soni, who is the CEO at Baroda BNP Paribas Mutual Fund, someone who has been taking you through multiple journeys of an investor over the last few months since we launched this series. And today, we're going to talk about something very, very interesting, which is behavioral science. We often end up talking about product features or categories, but today we'll understand from Suresh's vast experience in dealing with investors as to where do we go wrong. Why is it that mutual fund investors are 3 to 4 crore in a country of 140 crore? Thanks very much, Suresh, as always, for coming by on this chat. And my first question to you is, the fear of loss. Many people just stay away from financial markets, and it's not just equities, whether it is bonds, even gold ETFs, or REITs. The feeling is if I'm going to the financial market, I'm going to suffer a loss. And therefore, I rather just stay put in a savings bank account or an FD. So, what is your view on the fear of loss psychology of people?
No, I think you know investors behave in sometimes in relatively strange ways. So in our country, we have a large mass of people who put money into bank deposit, obviously considered the most safe. But we also have about 15 crore plus people who have dabbled in crypto.
Hmm.
We have more than 2 crore investors who have dabbled in F&O, despite the fact that you would have come across that SEBI study, which said that
Yes.
90% of them make losses. And I would imagine the crypto experience would not have been any different. So either people want to be very safe or they want to go for something which appears to be get rich quick kind of a proposition. Unfortunately, there is a, let's say, more steady way, or rather, fortunately, I would say, there is a much more steadier way of making money rather than either letting your money rot into, let's say, low yielding or not even inflation beating deposits, or speculating your money into a segment of the market where 90% of people end up losing money. So, very simply put, bank deposits appear to be low risk in short term, which they are. However, they are probably a very high risk from a long term perspective because they almost nearly guarantee that you will be below inflation in terms of your return adjusted for tax. So when you are signing up for long term into it, you're almost guaranteeing that I would at best keep pace with inflation or probably will be even lower than inflation in terms of my return. And at the same time, there's a very large mass of people who are willing to punt on relatively, let's say, quick fire things, whether it is online gaming or even for that matter, cryptos, F&Os, or whatever you have. A simpler way to make money, of course, is taking a slightly medium to long term view. Keep aside your money, and you would make much better return by investing into broader equity market or mutual funds, which have demonstrated over multiple decades.
The other word I hear a lot of peers of yours and you and the industry and talking more about it, which I think is very good, is the recency bias. Most people tend to look at a very short-term period behind them. Could be 6 months, year. I remember, when one went for investor camps, people would say, which is the best scheme? And just go do some Google search and see, okay, which are the names coming on top. How do you explain that? And now a lot of your peers and you have been talking about the fact that that's the worst mistake you can make. And now surveys are coming out, studies are coming out, research is coming out, which is showing that maybe just because you were on top the scheme a year ago or 2 years ago doesn't mean you were on top or you will be on top 3 years from now. So recency bias is the other big mistake investors tend to make. If you could tell us a little about that.
So there are two parts. First, I think I just want to elaborate a little bit on the previous point that you raised. You see, one of the reasons why people have fear about the markets is also relatively unpredictable nature of the market in very short term. So you ask any one of us to predict the market on a day, where will the market close today? Chances are 50% of people will go wrong on it.
Hmm.
But if you really ask us to predict it over a period of next 3, 5, 10 years, chances are most people will be able to predict it a lot better. It's almost like asking you, what would you do tomorrow at 11 o'clock? I mean, you are a busy person. You don't know exactly what your schedule is going to be. But if somebody says that 15 years later, what would you be doing? Maybe I'll be retired and I'll probably be relaxing and playing with my, traveling the world or whatever.
Maybe
So
still
it's,
interviewing Suresh.
I'm sure you'll be conducting interview. I'm not sure whether I'll be worthy of interviews, but nonetheless. So sometimes the predictability, and it's more true for the market, that the predictability improves significantly with elapse of time. Because even if there are, in the very near term, the movement tend to be random, but over a medium to long term, they are much more linked to the fundamentals. So that's first part. Now, coming to the other side where you asked about why, sorry, if you could repeat what your question
the,
was.
the the recency bias.
So recency bias, sorry. So recency bias, I think, all of us tend to have some influence of what has transpired because this is all about experiential. So unlike, let's say, a formula that you get for a deposit, which will pay you 7% every year for next 7 years or 5 years, in market, the only tangible thing you have to go by or you have available to you is what it has done. And sometimes that tends to influence some of the decision making because that's what you have experienced or that's what you've gone through. This, however, is one of the worst mistakes people can make because things tend to even out over a period of time. Markets tend to normalize, and somewhere or the other, the returns tend to turn towards the broader economic growth or broader corporate profit growth, which in case of our country, let's say if you look at it, our GDP growth tends to be about 6.5, 7%. Inflation tends to be about 5%. So overall, the return of the market would tend to reflect what the nominal GDP growth is, which is inflation and real GDP growth, which will come to around 13% thereabout. So market return would tend to be somewhere closer to that, slightly better than that. There would be years where it will probably be slightly lesser. There'll be years it will be more. But trying to go strictly by last few months is short a recipe for disappointment because market movements are never in a straight line.
That's true. The third aspect I wanted to talk to you about, Suresh, is this whole desire to act. I'm sure you must have been every time the market falls, including on the day that we are recording, we've seen a correction of almost about 3,000 points from the peak. The minute, or I remember when COVID struck and we had that sharp fall, people didn't need the money, but they were making calls, and many, I'm told, from financial planners who I, keep speaking to, that many withdrew actually.
Yeah.
They didn't need the money, but they just wanted to feel that I have to act. And maybe that's where, a lot of notional losses get converted into real losses by people. And then the next year, when the markets rebounded, they were all feeling sorry for themselves.
So really what happens in the market, I think this is one of the few places where greater activity does not lead to better outcome.
Mm.
So you don't have to work too hard on this. I think the greater activity has to be there before you made investment. And then if you want to do, you have to monitor what the company is doing rather than what the stock price is doing on a daily basis. So all that you do is you take a medium to long term view, you keep monitoring it through the year, through the journey of the company, and then see whether the company is playing out as per your thesis or there is a course correction needed. But coming in every day, and just because the share prices get published, and just because there are 24 hours channels, does not necessarily mean we ought to do something. In fact, fewer decisions you make, uh, this is a field where you are better off. So I think most of us through our career would realize that what has created most value are probably about 20, 30 decisions that you have made in the entire investing career. If you really look at what Warren Buffett says, a bulk of his investment outcome has really come in from a few dozen stocks. And he has had one of the longest investing career that anybody can think of. And day-to-day activity doesn't add. If anything, it distracts you. And more often than not, you end up selling your winners too early because that is the only thing that kind of tangibly gives you a, let's say, an ability or a kind of a satisfaction of having made money. And what it also leads to is a situation where you end up sitting with your losers and sell your winners way too early. So the business channels are there to give you the information, but it does not necessarily mean that every day you need to act on it. Even as professional investors, there are times when you actually say, oh, I wish I did not come to office because all that I've done today are decisions which have probably subtracted some value rather than adding value to the portfolio. So these are something which are our cognitive biases are in a certain direction, but we need to train our mind a little bit and stay focused on medium to long term goals rather than getting caught up into the noise. Markets are a noisy place. Every single day there'll be noise. And again, if you really look at it, today, if somebody had invested in 2018 and held his money for 5 years, probably his indexes are nearly the double what it was about 5 years back. But within this period, you had one of the worst economic crisis. You had one of the worst health crisis that happens once in 100 years. You saw interest rates coming down to the bottom that was seen any time, and now they are at a period at a level which was one of the highest. And you also saw wars happening. If you acted on every single bit of these news, chances are you would have exited at the wrong time. But you sit through it, you realize that in 5 years your money has doubled, your portfolio has probably delivered you twice the return that a fixed income investment would have delivered without having to really do too much on a day-to-day basis. In our investing career, we realized that some of the best investments that we have made are the ones that we have allowed to compound over a period of time rather than fiddling every other day.
Suresh, when you, me, we started our career, I still remember that every time when the market fell, many people, activists, brokers, a lot of people would say, SEBI used to blame, that market gir gaya, regulator ne kuch nahi kiya. Thankfully, we've come a long way. In fact, PILs used to be fine. Okay, market has fallen, SEBI did not do. It was a lack of awareness, lack of knowing what is equity, what is the risk that comes with equity. Of course, the role of the regulator, it was a very young regulator at that time. Of course, we are way behind all that. But somewhere I still feel that people do not understand their own risk-taking appetite. And, as professionals, experienced professionals like you have been saying for so many years, that no two people will ever have the same risk tolerance, and which is why these formulas, thumb rules, 100 minus X and all may be a good, directionally a way of encouraging people, but how does one find out? I mean, I know today with technology, there are a lot of places you can go and punch in things. Financial planners do a great job of actually identifying your risk tolerance, advisors, I meant. Uh, how, how do you feel that people should identify their risk tolerance before entering?
So I would say, I think sometimes, it's good to do selection by elimination. So one of the ways in which one should think about is, what is the part of money on which I can take no risk? And that part of the money has no business going into stock market. This could be your emergency funding for a period equivalent to your 6 months expenditure, or it could be something that you want to keep aside for a goal which is nearly a year and a half away. Let's say if you were to buy a house and you have been saving up for it, you don't really want too much of volatility in that part of the money. Or if you have, at any point of time, it's always a good idea to have some money in reserve so that you are able to take care of a bad day. So once you identify that, then you know that with rest of the money, I can take some liberty of investing it for slightly medium to long term. And if you are able to convince yourself before you begin the journey that this is my this is the pot of money which is going to be safe, and therefore this gives me peace of mind, this allows me to kind of meet any emergency withdrawal, then you are able to, by implication, invest rest of the money for longer period of time. So identify what you can't invest and then invest what you have for longer period of time. And if you're able to do that, then I guess it will kind of clarify thinking a lot more.
And
The
given
second
your, sorry, I'm sorry.
second thing I would say is that naturally most of us end up anyway exposed to fixed income by a meaningful magnitude. For example, as a salaried employee, a part of my salary always goes into provident fund and sits there. Now, it's a pity that it's the longest maturity investment that I make. But it up till of recently, it used to go only in fixed income. Thankfully, now some part of it has started going into equities as well. But that is largely fixed income. And so that's part of the money goes there. And then we also keep some money aside as liquidity. So a large part of our money anyway tends to be into fixed income. And therefore, investors should consider definitely allocating to equity, because that is the only asset class that can create wealth over a period of time, rather than just keeping you at par with inflation.
Suresh, it is said that the risk of losing money, and again, this is all in hindsight, nobody can predict the future, but 30 years, 40 years of studies have shown that if you had stayed invested for 7 years or 10 years, uh, on historical data, you've never lost money.
Yeah.
So, you've been pretty much part of the private sector mutual fund, journey for the last almost 30 odd years. What has your own experience been? I mean, does equity, if held, now that's a big if, because most people, as we've discussed in this interview, tend to, for various reasons, not stick it out. But it's very sad to see X scheme gave 25% compounded returns over the last 25 years, 30 years, and most people of my generation either never owned it or never held it for that long to get that kind of a return.
No, yeah, that's very true. But those who, and the small minority who have held it, I think they are super surprised when they see the returns that they've made over a period of time.
Yeah, absolutely.
So we also need to understand that, for generations, we have held gold. For generations, people have held property. Investing into equity market has been relatively a last 50-year phenomena as far as broader India is concerned, and mutual fund is a 30-year phenomena in that sense. And therefore, somebody who invested about 30 years, 35 years back, whether they really had that long-term vision is a tough one to say.
Yeah.
However, today you have a far better situation. You have seen the performance now for 30 years. You know that the industry is well regulated. You know that over a period of time, even worst of the funds have outperformed the deposits almost by 100% margin. So to that extent, you have your expectations or the past result both available to you very clear.
Mm.
Indian economy is in a much better place. So today, for somebody, there is no excuse for not taking a long term. In the past, I would say that as India was evolving, people were experiencing these asset classes. The time period tended to be a little shorter because people did not really know how this asset class will behave. Secondly, what has also happened in past, in all fairness, is we have been hit by multiple rounds of scams. If you really remember, in early 90s, there was Harshad Mehta scam, then there was Ketan Parekh and stuff. So some of these have laid an impression in people's mind as to this place is not safe. In all fairness, our regulators as well as the exchanges and the all the authorities like NSDL and everyone have done a phenomenal job of making this market a very safe place. In addition to that, over the last 30 years, the fund manager community has also delivered a very strong performance. So today you have no worries about any of these factors. This is in a good place. This is an asset class which is demonstrated now very clearly that it compounds over a period of time. And all of us, I wish we had that much maturity when I started investing earlier. But all of us now have a very clear opportunity to invest for longer term and create some serious wealth for ourselves.
Always a pleasure talking to you, Suresh. Soni, thank you very much once again for coming by and sharing some very, very interesting perspectives about human behavior. Thank you very much for your time.
Absolute delight, Vivek. Great.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.